You're listening to RIAcast, a podcast of the Southwest Florida Real Estate Investment Association. RIAcast brings together a variety of real estate entrepreneurs from all over the world to share tips and ideas. The core purpose of the Southwest Florida RIA is to help members become more profitable and successful through networking, education, and empowerment. Here are your hosts, Jeff Tamarello and Michael Lyons.
Welcome to the RIAcast. I'm Mike Lyons, one of the directors of the Southwest Florida RIA, joined by the other director, the more handsome director of the Southwest Florida RIA, of course, Jeff Tamarello. And Jeff, how you doing, man?
Good. How you doing, Mike?
Good, man. Good. So today's RIAcast is going to, Jeff and I are going to discuss how to build a real estate portfolio, a successful, profitable, cash flowing real estate portfolio. And Jeff and I both have experiences me as a property manager and Jeff as a real estate broker. And
actually, you and I put a pretty good portfolio together, a chunk of a pretty good portfolio together as a joint venture.
Agreed. Yeah, and we'll go over that. And Jeff, just to get us started, I mean, where would one start? Where someone's going to start to get the process going?
Well, the number one question you want to ask you've got four basic questions that nobody answers. They just go, I want to do deals. And number one question is, how much capital are you looking to employ? And that is the key word, employ, not deploy, because I can tell you as a Marine, sometimes when things deploy, they don't come back. So like I have some gear that's still in Saudi Arabia that deployed, but I don't know where it is. Yeah. So I have a Walkman buried in the sands of Kuwait actually somewhere too, but you want to employ the capital, but how much capital you're looking to employ, and that really determines what field you can play in. If you've got $4,000, you're probably playing in some lower end lots, and unless you're going to do some really high LTV leverage. If you've got a couple $100,000, well, then there's a lot more you could do, whether you want to do a couple duplexes, in one area or one really nice house. It depends. Now, the rest of the questions, how much capital are you willing to employ? You really have to determine a minimum, I call it a minimum desired rate of return. It's my get out of bed. I'm not getting out of bed for less than X. Like for me, when we're not talking about flipping, but on a flip, if I don't see 20%, I'm not doing it. There's no way I'm not, because I know I'm probably, if I'm booked at 20 in the beginning, I'm probably not netting 20 real world.
Well, and from a realistic standpoint, and maybe we're jumping ahead a little bit, but what would be a realistic outlook on a return? And that kind of depends on the investment, but what are your thoughts on that?
A lot of the old timers shoot for 7. Some go higher, and it really depends whether you're a levered or an unlevered return. Sure. It's really easy to hit some 20-30% on a leverage return. It's really hard to hit 20-30% on an unlevered return paying cash, because you've got your cash on cash return. But, you really want to define, I need X or else I'll just, ladder it in CDs or put it in a mutual fund or something like that.
And be realistic with it, I think it's super important. Because I've heard investors on cash deals wanting to get 15%. And I'm like, that's going to be tough to find, man. You find that and I'll buy them with you.
I had a guy call me wanting 20% a year cash on cash returns unlevered. I'm like, let me know anything you have that just doesn't quite fit your criteria. I'll take it. 100%. I'll take that. So, and this is for a portfolio, but it's in a portfolio, you kind of blend it out too, because you've always got, we have one investor that I put him in them and you manage them. And I think it's 29 of them. And he's got some that are amazing yields, some that are really good yields. And, he doesn't have any pigs in that portfolio because he bought them all for $50,000. Yeah. But there's some investors that one or two of their properties are, they obviously didn't have a formula when they bought them. They just felt good about it. That's why you really got to define out the formula, define what you're there to do. The third question is, when are you going to need this money back, if ever? That's really important. Hey, I'm 45 years old and I'm going to need this money when I retire in 20 years. So make sure that, that capital returning out, coming out of these transactions, your goals fit the assets trajectory, I guess would be the way to put it. And then
have an exit strategy, basically.
Yeah. Well, but exit strategy, what? I mean, give an example, the portfolio we were just talking about. He bought those with the intention that when he could make $100,000 a unit, he was going to sell every one of them.
Yeah.
We're way past that. But the problem is, if he sold them, what are you going to do with the money?
Right.
What are you going to, buy Apple stock? You're going to get a CD. Yeah. I mean, he's
versus
making a really good, he's making great returns. So, of course you pivot and go, you know what, this is my new source of income, which what he did of not hitting that, when he hit that goal and not selling them, as his broker, I was a little disappointed, but as an investor, I was pretty happy for him because he made the right decision. Because, you and I are both brokers and investors. So, and then the fourth and basic question is, what is your risk tolerance? And that's really age specific, because at some point we're all gearing up for retirement. So you're really looking at, in your 50s and 60s, you probably shouldn't be swinging for the fence. In your early 20s, swing for the fence. There's no, even if you make a mistake, you've got a lot of time to recover from it. I can remember having coffee with investors in like 2007 when, everything was coming apart. One guy was 65 years old. And in the back of my mind, I'm like, I have no idea how he's going to actually bounce back from this, because we haven't seen him in about 6 years at the REIT. I don't know what he did. I think he just retired and lived on what he could. But swinging for the fence at 65 can be problematic if you miss.
Agreed. Yeah, agreed. Well, so that's the questions, and that's a great kind of a plan on what to do first to get started. But what kind of team do you need to put together to make this all happen, to get a portfolio going? What kind of advice would you give on that?
Well, you need everybody.
Yeah.
You need, and that's, again, if you're not going to self-manage, you need a property manager, and you really need to, and we're going to do a whole recast on how to hire a property manager. Yeah. But, because a property manager is actually a single agent of the owner, which in and of itself has legal issues that could come back. Sure. On the thing. But, that property management agreement is so huge. But, you need your property manager, or unless you're going to manage it. And if you're going to manage it, you're going to need some kind of a system, some sort of software, some sort of something, because it's really easy for this stuff to get away from you. You're going to need somebody to help you buy it, whether you're doing it yourself, whether you're, wholesalers, realtors off the MLS. Generally, to build a bigger portfolio, what works is everything. You really want to just, have a fishing pole in every pond out there. You're also going to...
Let me stop you there for just a second. When it comes to acquiring property, though, and I'm going to pitch what you can do. I mean, if you're going to do business with someone to build up a portfolio, I would not do business with someone who's never done it before.
Yeah.
If you're trying to build an empire. I mean, I mentioned that. I know you've done it several times. I mean, you've got to work with someone who actually has done it before, and not just a guessing game for them too. And I know that kind of goes without saying. You need to really interview the person you hire to acquire the property for you, if you're not doing it yourself. I think it's worth saying.
It's really a commercial transaction, and so it's not. It shouldn't be as salesy. It should be a very business-like transaction. You sit down, you answer the 4 questions. You take that. The answers to those 4 questions should define a pretty good path, and then you start on the path and then see what happens. Sure. And the key is once you set a model, don't deviate from the model.
So you mentioned property manager, you mentioned getting a real estate broker or agent, unless you can do it yourself. But even then, unless you really know what you're doing, I would caution you to hire a professional, at least walk you through a few of them. Go ahead.
You're going to need a really good home inspector, because the last thing you want to do is have those surprises. You're going to need a insurance agent who actually understands what you're doing. Just because your kids play soccer with so-and-so agency, if they're not really investor versed, it doesn't work. Contractors, you're going to need some, because like what we would do on most portfolios, say you get the inspection, you make it through the inspection period and say, okay, we're going to buy this. In the inspection period, we had the whole entire inspection report bid. So what was awesome is that if you've got one contractor who's doing the work, you then just, you've already got your bid. They know everything that needs fixed. You can decide maybe you don't want to fix every little thing on it. Yep. Intelligently, you would fix every little thing on the inspection report, because good properties.
when they go to sell it, if that day comes, or it'll be an issue later on while a tenant's living in it and it's occupied. So
yeah, well, good properties attract good tenants. Crappy properties attract crappy tenants. It's
totally true.
Accountant. You're definitely going to need an accountant who understands real estate, because the guy at H&R Block who's done your 1040s may be a cool dude, but once you've got a Schedule E and you've got all that going on, you need competent help. You need somebody that actually knows what you're doing.
Good, and I agree. One thing I want to go back to when it comes to getting a contractor, and this is not the case for every contractor, but in some cases, the first job they do great, the second job they're pretty good, and by third and fourth they kind of fade. I've experienced that. So
I think it's that they take you for granted, and then they get busy, and then they get another job. And I don't think most of them mean to do it that way. They just, particularly if you're not hiring somebody who's a business, it's a guy with a tool belt, which that's usually the best pricing is a guy with a tool belt. Yeah. But they're not a business for the most part. They're a guy with a tool belt. And if they get overwhelmed, then it's pretty apparent they don't have a business plan.
Also, don't pay them till the job's done. They might ask for half down or a third or whatever for materials, maybe, but I know people in the past have gotten burned on paying for a job and then the guy never showing up again. So
one thing I do want to share is when you're communicating, it's really easy to get on the phone and text everybody. I've found that important business communication that's in what I call could be actionable someday in a court of law should all be done on email, just because it's a little easier. It's a little more admissible. I know texts are admissible, but I'm finding that really important business communication should be done via email. That way everything's in writing. There's a record. It's easy to pull it back up if there's a discrepancy on, hey, I meant to do this or I meant to say this. You've got a written record of what was supposed to happen.
Oh, you're covered. I've had it happen from the property management standpoint where with tenants agreeing to do things or even with contractors. And, we were never supposed to do that. And you kind of forward them the email where they agreed to doing that. And then, they got to go back and get on it. It doesn't happen very often, but it's really kind of a safety net for that. So I agree.
Now, when you're acquiring them, I mean, you set your model. You really have to determine what you're buying, whether it's single family, multi, even commercial, whatever. And then you go out and you write your offers. That was the other day, the one portfolio we were discussing that we put together in 2009. I found the spreadsheet of all of those offers. Oh, and we wrote 4 offers for every property that we bought. And the interesting thing was we missed on some properties over $1,000. And I'm looking at some of these houses that, like, especially some really nice ones in the Cape that all day are $210. And, we wouldn't pay $52,500. We would only go $51,500. And it's comical now in hindsight. And that's another thing too. You want to put a system together, whether it's a spreadsheet or some sort of software. You could even do like Asana. There's a lot of platforms you could use for this. But you want to, when you're writing your offers, again, it's a business. You really want to put a spreadsheet together, more importantly, so you can go back and, see what you're missing, what your opportunities are. And it's good to save that and go back and review it. So say you employ what capital you've got. A few years later, you're ready to do it again. Especially say you buy 10 rental properties, you're going to forget all about buying them after trying to deal with 10 rental properties for a bit. Okay. So you can go back and figure out exactly, what we did to get to here.
And hearing too, remember back in the day when people are like, I won't pay $50,000 for that duplex. It's like, oh,
yeah.
If they only would have
$300,000 now.
Oh yeah.
So some of them, it's pretty insane.
Yeah. Well, good. So it kind of went over, what questions need to be asked and then answered, having a plan, what team you need. You mentioned having a plan of kind of a breakdown, plan's the right word to use, but some kind of formula to approach purchasing property. I know we use the APOD. You want to go into that a little bit and discuss what that is?
Well, the APOD, when you join the RIA, you get it emailed to you. It's a spreadsheet that was built to put money in motion. It's a really simple spreadsheet. That's what's nice about it. I find that the more complex the analysis, the more likely you are to delude yourself. You really want to underwrite an asset based solely on the asset, particularly on, say, you're doing residential stuff. But you can get into the internal rates of return and all that. but you really don't want to use taxation. I kind of use it as, taxation, depreciation, all that is great. And that's one of the reasons why you own it. But most importantly, you need an asset that pays you to own it to start with.
Correct.
And I would equate it to buying some roast beef that's mediocre because they just do such an amazing job with the gravy.
Yeah.
I'm not buying roast beef for the gravy. I'm buying roast beef, and then I want good gravy to go with it. And you really want to make sure you're buying assets that pay you to own them outside of taxation, outside of depreciation, outside of all those things. And,
there's been countless times where I know you and I've discussed it, where either members of the group or investors will approach us with, hey, I got a deal. What are your thoughts on it? And then we run the numbers on it. And after you take into consideration the purchase price, the holding costs of insurance, taxes, potential vacancy, and expenses of having the property, they were paying money out each month. They weren't earning anything. And real quick, you look at the numbers, go, that doesn't make any sense. But if you don't analyze that kind of stuff, you could get caught on a bad deal.
Oh, the 05 Real. I mean, they used to make me go to the bar and get me out of the room when they would pitch those $330,000 North Cape 1,405 square foot, whatever it was, 3.2. They're rented for $1,800 a month for $330. I was like, that's an act of lunacy. That's not an investment.
Yeah.
But that was all.
1,000 for $1,400 a month in rent, or $1,800 a month.
Yeah. Or the stuff in East Fort Myers at the time was renting for $1,800 a month, and I owned a bunch of property down there over the years, and I'm like, that's not a long-term sustainable rent. Yeah, everybody didn't have a place to live, and we had all those contractors here from Charlie that really just kind of pumped the market up, all the roofers, and we had an influx of people to fix stuff that, that's why those rents were, but they just were not sustainable whatsoever.
No, totally agree.
Let's talk about, and this is something you should be adding a lot to because of your expertise. Sure. What areas work? I mean, for me personally, I've found that anything in unincorporated Lee County just works better. It's a little less brain damage. The taxes are a little lower. Even your tenants' water bills are lower, as compared to the city of Fort Myers, city of Cape Coral water. And I know there's somebody that'll try and prove me wrong, but long-term, I found that, the lower cost to keep is what makes long-term holds better. Okay. And when you're not in a city, I think the easiest way to put it is you're only supporting one layer of government with your tax bill.
I'll agree with everything that you said. I'll also say, I get the question a lot about well and septic, having well and septic versus city water and city sewer. And it's an obvious city sewer and city water is better long-term, because you're going to have issues with the septic if you have one, and you're going to have issues with well equipment if you have, if that's the system your investment has. So whenever you can, if you can still get a good deal and it cash flows in circumstances where there are city sewer and city water and included, in the area already, that's awesome. I would pick that first over one without it. But then again, I'd also say is just know that if you do get one, you can still get deals with property that is well equipment and septic, but just you need to put some kind of reserve in, because they're going to go bad at some point. There's going to be costs associated with that you don't have with the other properties. But first pick would be city sewer and city water. Go ahead.
Say you get your inspection report and the inspector comments you've got 10 years left on the roof. So you need to figure out how much a roof costs and divide that by 10, and you should be saving that much money unless a hurricane buys you a new roof.
Right.
So, which is awesome when it does. I've had new roofs because of a hurricane, and it's a little bit of brain damage doing the insurance claim, but all in all, it's a lot better for the insurance company's check than mine.
Yeah. I'm glad you said that, because in a lot of cases, I feel like investors they see their cash flow, they watch the numbers, but they don't create a reserve. And real savvy, experienced investors have a reserve always ready just in case, because anything can happen. And this is, some really weird situations. I had a property in Lehigh that I managed, and it went vacant, and a car drove into it, the side of it, and took a wall out. Obviously, that's extreme version, but weird stuff happens to investment property from time to time. So my point is, you have to have insurance, or you have to have the reserves ready to pay for stuff randomly, because it's your cash flow.
And vacant properties just attract things.
Yeah, they do. Oh yeah. Yeah. And that's one thing. Let's go back to, you said kind of where to buy, and we're talking about Lee County. Obviously there's areas that, I will say this, there's no part of Lee County that I would say don't invest in. I think all of Lee County, you buy at the right price, you can rent it out. I've had questions. Can we buy property right here and still make it work? There's no part of Lee County that can't be rented. It's all rentable. And there's nothing I would shy away from, but just know what you're getting into. If you're buying in an area that's lower income, and not in all cases, but in some cases, you're gonna have a little more turnover, again, potentially. And that's not always the case. I've had tenants in areas where lower income, where it's been great for the last 8-9 years. I've had the same tenant. So that's not always the case, but you need to know where you're buying it. I wouldn't just, this looks like a good deal, and you need to do your research and find out in advance and make sure the numbers work. Because if they don't, there's no point in buying it.
Yeah. I'm finding some of the areas you just have to, in the APOD, you just have to put a higher vacancy rate.
Correct.
Higher vacancy rate, and you're probably going to you're going to have more repairs.
Yeah.
There's just more wear and tear in certain areas. And you definitely, part of building a portfolio is you want to diversify. What you don't want to do is have 28 houses in Pine Manor. So if something happens to that asset class or something happens in that area, that you're in trouble. And then you also, like one of the portfolios we did, I think 14 in Lehigh and 14 in the Cape. And it really didn't intend to be that way, but that's just how the deals fell.
Yeah.
But at the time, the best buys were the Cape and Lehigh REOs. Yep. And we split it up between the two. The interesting thing is because it's diversified, and just another reason to diversify, say you bought all of your homes in N2 in the Cape for water and sewer, and you had 28 homes all getting utilities this year, you're not going to have a dime of cash flow. You're going to invest every bit of your cash flow in the water, sewer, hookups, all that.
Agreed. Yeah, I totally agree. Here's one thing too, and we mentioned hurricanes because we're in Florida, but it's a reality every summer that we could have potentially. And the last hurricane that hit was Irma, and we had more damage from a portfolio management, from property management standpoint in Lehigh than we did in Cape or anywhere else. And Lehigh got the worst part of the storm. Now, again, that's kind of an extreme situation, but every probably 8 to 10 years, we can kind of expect having a pretty rough hurricane. And if you have all your properties in that one spot where that storm came through, you're gonna have damage on all of them potentially.
Yeah.
But I think spreading it out's a good thing. You got some right on the coast, you got some a little more inland.
Yeah, because the eye wall's 30, 40 miles across.
Yep.
Now the total, so the eye wall itself, the really damaging, isn't that big usually, 20 miles across max on a really big storm. Okay. So pretty good reasons why you don't want to have all your properties in a 2-mile radius.
In one spot. One thing too, and on that note, and again, we keep hitting hurricanes or storm related stuff, but I've had some discussions about buying mobile homes, and mobile homes, by the way, if you do them right, are one of the best cash flowing properties you can buy. But their concern is, one, insurance is typically pretty high, and what about storms? Well, if it's 15, 20 years old, it's been through several hurricanes and it's still standing and fine. So that kind of passes the test on, just to avoid, I think some people avoid investing in them with that concern that storm's going to knock out all these mobile homes, and they're all standing after all these bad storms we've had. There's been no issue, no problem at all. So if anything, long-term, more damage on single family homes.
Yeah, long-term, I always look, most of them have really flat roofs, so they don't have as much wind issues. But I always look, how many rich old people do I know that own an asset class? And I know the most rich old people in the industrial and in the mobile home space.
Yeah.
And, like we were part of Steelbridge Realty. We were the brokerage arm of a private equity firm. We did a lot of bad debt on a lot of really big commercial projects in this town, very quietly, not even known some of the projects that we were part of, because that was the best way to get the deal done. But I learned in that we bought a lot of office space to fund it. I mean, we got some great buys, $30 a square foot for, gray shell, brand new Class A office. Yeah. But, going through that, I learned that I might own an office for my own company to be in. I probably would not own an office as an investment, just because, generally every time the new tenant comes in on a 5-year lease, they want the coffee maker 50 feet away. And, it's just, it's a little more brain damage. Once you build industrial out, particularly, it's there. Yeah. And then mobile homes, when the economy's good, people need a place to live. And when the economy's bad, they need a cheap place to live.
Yeah. Well, I tell mobile homes, I deal with a few investors that have them, and man, they are cash cows. Mm-hmm. And they do really well on them. Anyway, that's worth mentioning, because I think people shy away from it. And there's real good cash in mobile homes.
I want to kind of close this out with too, that, part of building a portfolio is you make a plan, but you always got to be ready to pivot. And you always keep up with the industry. Shameless pitch, attending the RIA meetings is a great way to do that.
Yeah.
But
when these it's true, man.
Yeah, when these portfolios were put together, say 9 and 10, Airbnb was not a thing.
Yeah.
And
True.
if you're not keeping up with that, that's people are making a lot of money with Airbnb right now.
Agreed.
And and it's easy to get caught up in a wall and say, this is what works for me and I'm not changing a thing. And then the next thing you know, everything's passed you by and you're not making the money you could.
Agreed. Yeah.
And even that, I don't think I would do the traditional short-term rentals, rent for 3 months to a snowbird.
Yeah.
I don't have a problem with owning an Airbnb property. We're probably about to launch something on Airbnb personally. So
Airbnb thus far, I think, is the little I've dealt with it, which hasn't been tons just yet because I don't focus on the vacation rental side of things. But man, it's changed the industry for vacation rentals. It's really helped it in a lot of ways. So
it's you just don't have as much control. Basically, they just book it. So you better hope Airbnb's keeping up with them.
Yeah, agreed. Anything else you want to add to the?
No, it's just really important. Number one thing on building a portfolio is what are you there to do, and whether you got $4,000 or $4 million, you really define what you're there to do. Intelligently approach the assets. In real estate investing, there's really 4 types we encounter at RIA meetings, and I'm maybe in trouble for saying this. There's investors. Okay, you put a chunk of money somewhere and you get a yield. There's traders, which, that's flipping. I do it. You've done it. We all will, but it's really not investing. It's trading. You're taking an undervalued asset, doing something to cure the deferred maintenance or adding, improving, and then, capturing the yield. And then there's the players, which at one point in my life, I would be considered a player. I did not have a system. I was wheeling and dealing. I can remember sending Christina to go sign for a property that I hadn't even looked at.
Yeah.
I just knew, even if we got to put trusses in, it's there, it's fine. I mean, with that said, we probably had flipped 15 houses within a mile of this, so I 100% knew what was going on, and I did have somebody drive by in the morning to make sure it didn't burn down the night before, which would have sucked. But that would have really sucked. But we were bound the day we bought it though too, so maybe not. But and then you oh God, I lost my train of thought because I was thinking about the burn down thing.
Well, we had the 3 burn downs I've dealt with this far, and they've all worked out really, really well for the individual who owned the property. The check they issued to
get on a tangent on that, if you have a total loss, there's really not a lot to it. I mean, the partial losses, like some hurricane damage, are tough because that's when you've got to get in. I mean, this probably needs to be another RIAcast episode. Yeah, but the total losses are easy. I had a rental property burned down in 2007 and really didn't know what to expect and was in a bit of a panic. And when I called my insurance agent and he's like, how much do you owe, Jeff? I'm like, I owe 97. He goes, well, I'm like, you're insured to 152. And I'm like, so you're going to cut me a check for 152? He goes, yes. I was like, okay, you're great. I've never turned down insurance after that.
I'm so bummed out that it burned down. It's so sad.
Yeah. Well, the key is nobody gets hurt. You got to make sure if nobody gets hurt, then you know what I mean? It's just a financial transaction. If somebody gets hurt, then that's pretty bad. That's terrible.
Oh, absolutely. Yeah. Agreed.
But yeah, when you're building a portfolio, decide what you're there to do, make a plan, and stick to the plan. Because the player side, which is where we were, I got to where most investors, when you become successful, you get the Midas touch. And then at some point, the Midas touch you'll make a mistake, and it will remind you as to why you don't do what you just did. Why you have to have a system, you have to have math, you have to have all that.
Yeah. Well, Jeff, great discussing this with you. For all those listening, you're more than welcome to subscribe to this. This will be on YouTube, obviously. And we'll put out a bunch of these. The hope is we put them out once a week, every other week. What's our goal?
That would be really awesome if we define that.
Okay, we're going to work on that for the next one.
Yeah.
All right, guys, we'll see you.
Enjoy it, Mike.
All right.
This concludes this edition of RIAcast. Be sure to subscribe to receive our next episode. You can also subscribe at our website, www.swflreia.com. See you at a meeting soon. Please let us know if you have a suggestion for a future episode.